The shocking move that made Biden seek China's help. The United States and China is heating up like never before. According to a recent report by Reuters, the U.S. government is in talks with China about potential visits by top officials, including Treasury Secretary Yellen and Commerce Secretary Raymondo. But that's not all. The Wall Street Journal has also reported that a senior official from the U.S. Treasury Department recently visited Beijing, indicating that diplomatic communication is still ongoing, despite the rocky relationship between the two countries. Meanwhile, the U.S. is facing a multitude of financial pressures, including aggressive interest rate hikes by the Federal Reserve, sky-high inflation rates, a banking crisis, and an increase in the debt ceiling to prevent a government shutdown. On top of all that, the global trend towards de-dollarization is also causing a headache for the U.S. But don't worry, folks. The U.S. has no plans to economically decouple from China or limit its growth, according to Undersecretary of the Treasury Jay Shambaugh. While the U.S. may have opinions about China's economic policies, it's not practical or in their best interest to fully separate the two economies. The Biden administration is eager to ease the current debt crisis, and Treasury Secretary Yellen's visit to China is expected to ask the country to stop reducing its holdings of U.S. debt. The federal government's fiscal deficit is growing at an alarming rate, and if this trend continues, the total debt could reach a staggering $51 trillion in just 10 years. Amidst all this chaos, the World Gold Council is discussing the future trend of gold purchases by global central banks. With so much uncertainty in the air, it's anyone's guess what the future holds for the U.S. and China's relationship. But one thing's for sure, we'll be keeping a close eye on developments as they unfold. For over a decade, the world's foremost central banks have been mired in a precarious quagmire, compelled to amass colossal amounts of U.S. treasuries despite their infamously paltry or even negative yields. Yet, with the recent implosion of the American economy and the reverberations of the Eurozone debt crisis still resounding in our ears, it is becoming increasingly apparent that this tactic may have been more perilous than anyone had foreseen. As the looming specter of default looms large over the U.S. economy, the once impregnable security of American debt has been called into question. In truth, a plethora of financial experts is now sounding the alarm that U.S. Treasuries have transmogrified into a high-risk asset, particularly when compared to the alluring glimmer of gold. It is no surprise, then, that China, always a shrewd player on the global stage, is presently mimicking the moves of the world's central banks and hastily shedding its U.S. debt holdings, opting for the safer harbor of gold. In fact, gold purchases are ascending worldwide as investors search for safer investments amid this turbulent economic climate. Thus, while the globe awaits with bated breath to witness the outcome of this high-stakes game of financial Jenga, one thing is unmistakable. In the realm of finance, nothing is certain, and gold may just be the gleaming panacea to our economic woes. It seems like China is putting its money where its mouth is, as the country's gold reserves soared to a whopping 66.5 million ounces at the end of March. That's a staggering 580,000 ounces more than the previous year, making the fifth consecutive month of increase. Interestingly, before November 2020, China's gold reserves had remained stagnant at 1,948 tons for a whopping 38 months straight. What sparked this sudden surge in gold holdings? Well, it seems that the winds of change are blowing in the world of international markets, and the once mighty dollar and U.S. debt are no longer the be-all and end-all they used to be. In their place, gold is emerging as the new superstar of the global economy. It's not just China that's jumping on the gold bandwagon either. Countries all around the world, including Malaysia, are now hastily increasing their gold holdings to levels not seen in over half a century. Why? Well, it's simple, really. Gold is proving to be a much more stable investment relative to the unpredictable fluctuations of the dollar. So, as the world watches with bated breath to see how these shifts in the global economy will play out, it seems that one thing is clear. When it comes to investing, gold may just be the new black. The gold central banks are on a gold rush like never before, According to the World Gold Council's latest data, the world's top financial institutions bought a whopping 125 tons of gold in the first 2 months of this year alone, making it the strongest performance seen since 2010. This remarkable feat marks the 11th consecutive month of net gold purchases by central banks, continuing the trend of purchasing we saw throughout the previous year, during which these financial powerhouses sought a staggering 1,136 tons of gold, a feat that hasn't been seen in over 55 years. What's driving this frenzy of gold purchasing, you ask? Well, it's anyone's guess. Some experts speculate that the global economy's volatility and uncertainty have prompted central banks to seek refuge in the relative stability of gold, while others point to geopolitical tensions as the driving force behind this gold rush. Whatever the cause may be, one thing is clear: central banks are doubling down on gold as an investment. And with 12 years of consecutive gold purchasing under their belt, it seems that this trend isn't slowing down anytime soon. Global central banks have been on a gold buying spree, acquiring a whopping 6,940 tons of the precious metal, and the trend shows no signs of slowing down. In fact, in recent years, the pace of gold purchases has been accelerating rapidly. It seems that central banks around the world are shifting away from the dollar and towards gold, a clear sign of de-dollarization of external reserves. This shift is apparent in the increased gold purchases by central banks, as well as their slower growth in U.S. debt holdings since the introduction of quantitative easing in 2008. Take China, for example. The world's most populous country has been steadily increasing its gold reserves for the past 5 months. And as if that weren't enough, China has also been ramping up its liquidation of U.S. debt, which currently accounts for 17% of its position. It's a fascinating trend to observe, one that hints at the changing global economic landscape. Who knows what other shifts and changes we'll see in the years to come? One thing's for sure, though: the world of finance is never dull. As the global economic landscape shifts, China seems to be taking deliberate steps to reduce its exposure to the U.S. dollar, with a particular focus on divesting itself of U.S. debt. This is evidenced by the fact that China has sold U.S. debt on a net basis for 12 of the last 13 months, and its total U.S. debt holdings have fallen below $900 billion for 4 consecutive months. But that's not all. China's gold reserves have been increasing, indicating a clear effort to promote yuan assets and reduce reliance on the dollar. And China isn't the only one. France, Germany, Belgium, Saudi Arabia, Brazil, and Israel, all U.S. allies, have also been reducing their exposure to U.S. debt, reflecting a broader trend towards global central bank de-dollarization. European countries in particular seem to be leading the way in saying no to U.S. debt, taking over the flag of de-dollarization from Japan. France, for example, has sold a net $62.1 billion of U.S. debt in the last 10 months, the largest selling effort among European countries. And Saudi Arabia, one of the parties to the petrodollar agreement, has sold a net 10% of its position in U.S. debt, actively releasing signals to look east for good friends. This trend is not without consequences for the U.S. economy and financial system, which are facing increasing concerns over its debt. Even U.S. Treasury Secretary Yellen expressed in her April 10 letter to Congress that a failure to raise the ceiling on U.S. debt in a timely manner would result in disastrous consequences for the U.S. economy, financial system, and all the economic gains made in the last 3 years. As emerging market economist Jason Tuvey notes, Saudi Arabia's moves to divest from U.S. debt is a clear indication that it is strategically moving away from or reducing its investments in U.S. debt and daring to show its sword to the dollar. This highlights the threat posed to the U.S. economy and financial system by the increasing trend towards de-dollarization. All in all, the world seems to be at a turning point, with a shifting balance of power in the global economic landscape. As the U.S. struggles to grapple with its mounting debt, other countries are taking bold steps toward a future that relies less heavily on the dollar. It remains to be seen how this will all play out, but one thing is certain: the world is changing, and we all need to pay attention. And that's it for today's video. We hope you found it informative and thought-provoking. As always, we'd love to hear your thoughts and opinions in the comments section below. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. Thanks for watching, and we'll see you in the next